If you've never looked at a P&L, a profit and loss statement, we're gonna go over one today. And specifically, this one is on a self-storage facility, one from a seller provided P&L, and then one from our facility of our P&L and what that looks like. So let's just get to it and break it down. So this P&L is a profit and loss statement that was provided to us from a seller on our Umatilla property. So this was the profit and loss statement, and it's gonna be broken down monthly like you'll see in our facility. This one is broken down yearly. So when a seller brings you this profit and loss statement, it's gonna show your gross income, different sources of income, and then all the expenses broken down. And some people put in items in there that necessarily don't belong in there. So we'll kind of go over the P&L provided, and then we'll go over our P&L at our property. So when you start at the top here on the accounts, this is obviously, you see it's from January 1st to December 31st of 2020. So the rental income is $185,000 and change. And then the U-Haul income, he minus commissions here on storage unit insurance, which actually should be as an expense because it's not income, it's be an expense here. And then so his total income. So that's the total income he got for the year in 2020. Then you go down to the next set of numbers here, and this is gonna be the operating expenses. So first is like bank service charges that he put on here. That's obviously just fees that you get out of the bank for maybe wires and whatnot. He has his internet service, his software he uses. He was using ESS like us, so that's probably right on track with us. A lot of things that don't get put in, that we don't see in the P&L that also we forget to sometimes, we don't forget anymore, but we in the beginning didn't put in there was a credit card processing. So typically it's like 2.5%, 2.8%, 3% for credit card processing. And you do want to get everybody kind of on auto pay so you don't have to go chase people for payments. One of the best parts about self-storage is like these people could be set up on auto pay and they just keep paying and they never remember and they forget about their storage unit and they never come back for years. And that is on his P&L here. He's got his Florida taxes, insurance. Taxes and insurance is gonna be pretty much your highest expense. Payroll will probably be the next. So he has interest expense. So this shows that $63,000 on his expenses. This is not actually an expense to the company. That's his personal expense. So if you bought this property cash, you wouldn't have an interest expense because you bought it cash. So that's an item that should be actually below the line. So anything below the net profit is below what would equal your net operating income is below the line. So he has that in his operating expense, but it should be below net profit because it's not essentially an expense that's gonna be for everybody. That's an expense specifically for him. So his interest expense is based on his capital stack and how he's borrowing money. So for him, he can have interest expense of maybe he bought this with hard money and he's got 10% interest expense. Or maybe I can buy it with conventional or private money at 4, 6%. So that interest expense changes. And so that should be below the line, meaning below the net profit. As we go on, he has a small fee for licenses, office supplies. His payroll is his next large expense, which is $26,000 here. He's got property insurance, $4,000, rent expense. I'm not sure really what that is. Rent refunds, repairs and maintenance, the utilities, vehicle and fuel, county taxes, and then depreciation and amortization. So depreciation and amortization also should be below the line. So when you look at this, if someone just sent you this and you see the net profit is $26,000, you'd be like, well, that's not very profitable business. This property is not making that much money. How is he asking so much? But you really have to add back. So you would take this pretty much this $26,549 here at the net profit, and you would add back the interest expense, $63,710. You'd add back the depreciation of $32,886. So this is like a P&L basically to like show on your taxes. So these are items you would show on your taxes, so you'd pay less taxes based on your net profit. But these are not expenses that are for everybody. Again, the interest expense, depreciation, amortization would all be below the line, and you can add those back to this net profit. When you add back the amortization, depreciation, and interest expense to the net profit, it equals $125,000 net profit. So he's got that drastically changes the net profit in what you would see. So if you weren't aware of how to look at a P&L and what to add back, you might just pass on this deal quickly and say, hey, there's not enough profit there. But this is where you can see where you can add value. So for us now on this facility, 2 years later now, we have this operating with the payroll of $12,000. So we know that we can run these facilities as a by appointment on-call management because everything's automated. And so with us, we know, hey, we can reduce the expenses here on the payroll. And obviously we look for other items that we can utilize on this P&L. So like based on the rent roll we received, we also knew that we can increase the rent on this property. So that was pretty much the only spots where we really saw like where we can decrease expenses was the payroll. Everything else is pretty standard here, but he did have those items above the line on his operating expenses where sometimes you might not see, you might not know that doesn't belong there and have it included. So now if we go and look at our P&L and what it looks like, this is actually for a different property. This is for our Tampa property. And so our accountants break it down in a monthly status each month. So every month on the 15th of August, we got this report. So currently, if you go to July, it's broken down for the month. So we have our rental income, our insurance income. So that's a tenant insurance. So in this facility, we actually require that everybody have renter's insurance, tenant insurance, or they provide us a copy of their tenant insurance so they don't have to buy it from us. This is late fee income. This line's for late fee income. That will bring our total income. So for July, it was $22,000. So far, year to date, January to July, we're at $147,000 gross income. When we go down to expenses, the first line you see taxes and licenses. So in January, you'll see that it's the highest. We actually paid our taxes in 2021 in January 2022. So our property taxes are included in January here, but these other months, it's around 1,000 or so. That is the sales tax that we collect from our customers, and then we pay to the state of Florida. We literally just pass it on to the state of Florida, and that's what we pay each month there. For repairs and maintenance, obviously that's pretty self-explanatory. Our advertising and marketing. So that's what we're paying for marketing in our facility. So this one's not 100% full. We have some second floor units that we're looking to rent out. So we are upping our budget to get occupancy up in our Tampa facility. Insurance, we only pay that yearly. So that's right there in May. Our contract labor. So we don't have an actual employee at this facility. Our manager is a 1099. So she's a contract employee. She actually gets $1,000 a month. Some months might be paid like a day or so late. So that shows $1,500 here, $500, but it breaks down to $1,000 a month. Utilities, obviously, that's self-explanatory, electric, water. Merchant fees are the payroll processing fees. So those are the merchant fees for the 2.5% to 3% you pay for people using their credit cards. Management fee is our management fee. In the beginning of the year, we weren't taking management fees on the property. So that's for us, our company, managing the asset of the property. Office supplies and software. And then that's obviously self-explanatory. Paper, items needed, ESS software that we use to manage the facility. And then legal and professional services, that might just be, I think actually for this, that's our accountants. So we pay them $300 a month. Auto expense, we allow our property manager when she has to go, get items from Home Depot or whatever it may be, we kind of reimburse her or let her use it for gas. Bank fees, just little small fees there. And then meals, I think we visited the property and bought her lunch and whatnot. When you take down those expenses, you'll see that each month you'll see a monthly net income and then the year-to-date income, net operating income. Now, as you'll see how the other gentleman and his P&L had some of these expenses above the line in the actual expenses, we have it below the line. So we have one, interest income. That's what we would make on like the bank paying you very, very little interest on your money being in the account. So it's like literally pennies. And then other expenses, which would be our interest expense. So for us, for these 7 months, it's $20,000. So this is again below the net operating income, below the line. The depreciation broke down each month, and then the amortization. So our net per, how we would pay taxes on would be so far for the year $6,633 from January to July, where our actual net operating income, which you would base off of, what you're going to pay for the property and what you would divide the number by in a cap rate, that would be the $46,000. So that's how you want to look at a profit and loss statement. This is one of the most important things you get and you collect from the seller is the P&L to see what their income is and what their expenses are, and that'll give you an idea of where you can save money and where you can maximize the value. Let me ask you a question. You watch these videos, why aren't you subscribed? We're giving away valuable content of how you can own a self-storage facility, how you can buy deals creatively. You can do this yourself. Subscribe, watch these videos, stay tuned every week because we're putting out fire content and we're doubling down. We're gonna provide as much value as possible so you can do this in your town and make things happen.